joined by Charlie Peabody and Kevin Bakes Baker. All right, we had the CPI come in this morning. Charlie, how did it look?
I'm spot on with expectations. 2.5% core, 3+, reported. So you're getting a little bit of relief in rally and SOFR, I think, this morning. And some of the expectations of a December hike have been reduced again. I think coming into this morning, they were 50-50. I haven't checked, this morning to see how much they've come in. But so, less hawkish tone is the theme. I talked about this on Monday. Banks in general will see a drag on their net interest income from lower rates. And we highlighted 4 or 5 banks on Monday. I'll just reiterate. M&T, which is a buy-rated name for me, is the least sensitive to rate changes up or down. And that's the one I'm, continuing to own as sort of a core holding. U.S. Bank Corp, USB, does benefit from lower rates in terms of the rate sensitivity. And then you have Citigroup, which generally has a negative impact from lower rates, but more on the international side. And so, shouldn't be dramatically affected by, any move lower in rates if that happens on the domestic side. The 2 banks that are the most sensitive in a negative way to lower rates are Bank of America and Wells Fargo. They'll see about 3.5% of their net interest income, negatively impacted. Put it this way, about a $2 billion plus negative impact from lower rates. So it's a drag on their net interest income growth. So lower rates generally are not positive for banks. Banks are generally asset sensitive. Now, it is positive for the economy and growth and all, capital markets. So I don't want to say it's a net negative, but if you're looking strictly at NII, which I'm anticipating, peaks this quarter about a 9% growth, it's going to get tougher to grow NII into 2027. And I think by the second quarter of next year, NII or net interest income or top line revenue, whatever you want to call it, is going to be, maybe 3% year over year growth. So, to me, I'm not a big fan of buying the banks here. So let's leave it at that.
Charlie, why does Wells Fargo look so much worse than Bank of America? Bank of America is, wedging up into new highs. Wells Fargo can't get out of its own way. What happened on the earnings call or?
Yeah, Wells Fargo has been struggling with their net interest margin, and they had compression with the NIM for the last 2 or 3 quarters. And they're forecasting a lower net interest margin here in the third quarter as well. So the way they make up for that is ballooning the balance sheet, growing volume over margin. And the problem with that is now they're using up their excess capital. And so they're talking about, lower buybacks going forward. Bank of America, on the other hand, still has a lot of excess capital, has been improving its profitability and showing, productivity enhancements. If you one of the big bull arguments that's emerged over the last month or so for the banks is that they are big beneficiaries of AI. And if you wanted one poster child for AI productivity enhancements, Bank of America would be it.
Okay. There you go.
All right. All right. And then let's go, Kevin. What do you got today? What are you looking at, buddy?
I just bought this the other day. This is PSCH Invesco S&P Small Cap Healthcare. It is not all biotech. It's about 19% biotech. But there are Corcept is one of the big names, Glaukos, GKOS, glaucoma treatments, devices, and so it doesn't have the binary risk of a lot of the small cap biotech ETFs and individual names. I obviously wish I had bought it earlier, but I didn't. But my mission is simple. I go through 5,500 charts, find the 10 best, and this is the 6th best that I've found thus far. I'm roughly 40% in cash still. I own 6 ETFs, and I'm hunting for more. And I go through the best prospects out of my 5,500. Now I culled down to about 80 or so. and just find buy points that look good to me. We did not have the follow through here that I like, but small cap overall is acting well, and healthcare overall is acting very well. So I'm playing that theme.
Yeah, it's been a good run there. And you think about the healthcare trade, it's just like one of those things where it was totally left for dead, like no one wanted to put into it, and we've gotten a pretty good like reallocation. And I mean, look at that chart; that's pretty good, right? I mean,
yeah, I'm a month late, but better late than never. So I think it still continues.
Yeah, that got going in May, right? Like kind of where we are at the peak of the mania of kind of the Q2 tech trade. What else you got, buddy?
The other thing I have is, and that's why I wanted to talk to Charlie with him on, but the alternative asset managers are starting to turn, and I don't think it's just yesterday's NVIDIA announcement. The volume has been picking up here overall. KKR and Apollo look very good. The KKR earnings report was well received, and we're starting to finally hear that redemptions are coming in. Redemption requests for private credit is coming in below the 5% limits that the alternative guys place on their funds and their clients. So this isn't a definitive turn yet, but this is sticky long-term capital. They earn carry fees, and with IPOs picking up, you might have some better times ahead for the private equity portfolio. So I'm encouraged by this. I haven't bought them yet. This is the Van Eck Alternative Asset Manager ETF GPZ, but here's KKR, which is the number 3 name. That's picking up, and we'll see if it follows through on the NVIDIA halo. But alternative asset managers look like they're improving. I haven't definitively said that it's a breakout to the upside yet.
Bakes, you hit on the 3 themes. Redemption requests are slowing, absolutely. Yesterday's NVIDIA announcement shows that there's a new asset class that these guys can invest in to earn fees. And, the credit side still has, shows deterioration, but they're managing through it. There's one other thing you mentioned, I forgot what it was. Anyway, but you hit the highlights as to why these things have turned. From my perspective, they probably have a little bit of a run, into September. I'm looking to short them again and sometime in the fall, winter.
Okay.
Yeah, that's kind of what I think too. I think it's like, hey, they kind of were depressed, then they got a little bit, and then maybe there'll be a point where you fade them again. Like I'm not looking at this as like I love them or anything, but they've had a rough year. Let's put it, since this time last year, it's been a little rough sledding for these boys.
Yeah. You're seeing that in a lot of the laggard groups, which private credit and private equity have been one of them. But you're seeing that in home builders, and yet there's no fundamental improvement in the home builders. The housing existing home data that came out, was it yesterday or the day before, was still fairly weak, 4 million. You're running around 4 million, annual sales. It's not strong. They're still having to cut, prices. They're still having to add incentives. Maybe if we get some sort of, bond rally and relief, you can see some improvement. But I think it's all positioning and rotational type trading that's going on in these laggard groups like home builders and private credit. I don't think it's a fundamental improvement. So I would love to see these things jump another 20%. I'm not short any of them, haven't been since earlier this year, but I would like to get short them again.
All right. Anything else, Kev?
That's what I have for today. Ben, back to you in the booth, Ben.
And I just want to mention one other thing I forgot to mention at the top on inflation. So tomorrow we get PPI, and I think that's going to be actually more important than CPI. And PPI has been running on an annualized basis over 5%. So these input costs, I mean, we got some relief on the last, report on PPI. And if we get another, round of relief, that'll be positive. But if PPI still shows, 4 or 5% inflation, I think that's going to be more more important than CPI.
No. And then just mention, CoreWeave was up 22% today. That, strong demand outlook. We shorted that and we covered a lot of it when it was down 50%. But you see, that's a volatile. I mean, that is going to be a volatile stock, and so you have to think about it like that. It's 5-6% daily vol. But that, and so the whole space is kind of climbing up, which is exciting. And I guess just like the alternative investments, like there's gonna be a point here where I want to short all this stuff again. So just thought I'd make a little quick update on that.
Yeah, it's trading at the low of the day's range, and you've got this. Look at all the support you have going from. Resistance 114 to 138. That's going to be tough to eat through, I think, and we'll see how this closes at the end of the day. But already, it's the CNBC effect is waning.
Yeah, I think this is the 115 to 135 is kind of the sell zone. So just be aware of that.
Yep.
All right, I think that's it for the day. We're going to keep it tight today, boys. I am Ben Bry, as Charlie Peabody, Kevin Bakes Baker, giving us some Bakes takes, and we will be back at you tomorrow.
See you, boys.
Thanks,
Thank you, Jan. Take care.
Yeah, thanks.